Welcome to the Steps to Investing podcast, helping aspiring investors get to grips with the world of finance and investing. This week on the pod, Roxana Mohammadian Molina from peer-to-peer lending firm Blend Network. She talks us through how many small lenders are now grouping together to help property developers across the UK, and we look at the risks and returns involved. Hello, I'm Simon Longfellow.
And I'm Marcus De Silva.
And welcome along to this week's podcast. So, what have you been looking at this week, Marcus?
Yeah, I think one story that piqued my interest in the FT this week was a report on government proposals to overhaul the audit and corporate governance rules and stop company directors of large businesses paying out big dividends and bonuses if they haven't got enough cash on their balance sheets. And the reason is because we've had in recent years some fairly high-profile cases where businesses have collapsed following large payments to shareholders and executives. And the case in point is Carillion's implosion in 2018. Now, they were an outsourcing company. They did many different things to the government, really. I mean, one of them is managing smart motorway traffic control systems, those ones that tell you to flick down to 50 if there's an issue or whatever. Another was managing 50,000 military personal homes. So they did lots of different things. And they operated globally and employed about 40,000 people. And it buckled under debt. They'd been investing in pretty risky projects, hadn't paid off. They were too leveraged. Now, we get that, of course, businesses have risk, and this is the risk with businesses, but that wasn't the problem. The problem was Carillion's board was still paying its execs big bonuses just prior to announcing profit warnings in July 2017. And they'd also agreed some crazy deals with parting execs to continue paying them after they had gone. So what it comes across as is a very unlikable corporate ransacking, really. Loot the ship prior to it sinking. And the government wants that to stop, of course. Not only can you not stick your hand in the cookie jar when there aren't many left, i.e. raid the balance sheet, company directors will now face fines. They could have their bonuses clawed back, but the big one is bans from holding future directorship, which is really attacking your future earnings. So I think these are good deterrents from not taking those responsibilities as board directors seriously. And on that last point of bans, the government has launched in January a legal bid to ban all 8 Carillion board directors from ever holding senior boardroom positions again. So that's pretty potent. How about you, Simon?
Yeah, it is. I mean, interesting also because I've got a story coming up on a very similar topic in the news. So we'll come to that in a second. Well, I'm just going to give a quick plug for some new stuff on the Steps to Investing website. So out this week, we have a new blog post, which is some top tips from financial planner Felix Milton. We have some new videos in our videos section, so check out the new case studies and new fund manager videos. And then I'm just going to trail something that's happening in a week's time, which is the release of Get Investing issue number 3. So look out for that. We'll obviously email everyone about it, but it'll be on the website too. Yeah,
there's going to be lots of info in that. And the videos are really nice as well because these are sponsored videos. There's some of these glossy sort of higher end videos and really sort of peel back the curtain as we like to do really with the city and really see the fund managers, look them in the whites of their eyes type thing.
Yeah, very much so. Okay, well, as I said, in a moment we're going to look at property investing and how to get involved without buying the physical bricks and mortar for yourself. But first, the news. Let's start by looking at what's been happening in the markets over the last week. Marcus, over to you.
Yeah, well, it's all out the US really, and just one thing to remember: the part of the reason why the US is almost always mentioned is because it represents 55% of shares traded around the world. That's why it's so important. And of course, the US economy is the largest in the world. Now, so what's happened in the US? Well, the Fed got together for a little 2-day meeting and markets were gleefully lapping up the very economically supportive signals that were given off the back of it. In particular, there were a few points to note. So, interest rates are going to stay very low there until, according to Fed Chair Jay Powell, potentially 2024. So it's quite a long way out, really. The economy also, the US economy, will grow more than previously thought. this year, is what the Fed thinks, up from 4.2% that they predicted in December to now 6.5% growth in the US economy in 2021. Why is this suddenly be upgraded? Because Biden's much bigger stimulus package is coming through, and also they're very much liking the quickening pace of the vaccine rollouts. Other things to note: unemployment could drop further than they expected there this year. Their QE program, their quantitative easing programs, will keep firing at an enormous $120 billion of bond purchases per month. And a final forecast that was echoed by our guest last week, Ben Seeger-Scott, is that we will see likely only an optical bump in inflation in the short term before it drops back down. By this we mean that, and Ben described this in last week's pod very well, last year's prices dropped so severely just as we were going into lockdown, particularly oil, that it means comparative prices today seem like there's a lot of inflation, but really it's this sort of transient kind of, it's just down to the nature of the figures, really. So what this means is that the central bank of the world's largest economy are going to let that economy run without guardrails for a little bit of time in order to enable it to recover fully from the crisis. And this is very positive for any of those riskier assets out there. So shares, and in particular those more economically sensitive stocks that we have talked about quite a bit on this podcast. In bonds, prices have fallen. You would expect this from what they refer to as dovish comments from a central bank like the Fed. But importantly, they've been falling in quite a measured way. So investors are obviously believing the Fed when they say they're going to be able to keep control of the bond markets through their big quantitative easing programs, which is why we haven't seen any of this nasty selling of bonds, which we definitely wouldn't want because that can spook other assets, including shares. On Thursday, we see our very own central bank, the Bank of England, getting together for a meeting, and investors expect, similar to the Fed, that monetary policy will be kept loose and that there will be signals that it will be loose for some time. And I think what's interesting is that this century has seen something more unusual from central banks, and that there's this coordination. They realise that during times of turmoil, times of crises, that it's quite a good idea to coordinate and have similar messaging, because it makes what they're doing a lot more effective. Part of the effect of stimulus is the promise of it. It's the expectation of it, that things aren't going to be bad. Don't worry, we've got here with a backstop type thing. So coordinating globally, whether it's the ECB, the European Central Bank, whether it's the Federal Reserve, whether it's the Bank of England, whether it's the Bank of Japan, coordinating amongst each other and having this globalized kind of message does make their job a little bit more effective. So I find that quite interesting. All in all, the S&P 500 is up 59 points to 3,974. The FTSE 100 is up 11 points to 6,766. The Stock 600 is up 3 points to 426. And Nikkei 225 is up 923 points to 30,126. Simon, what have you got for us?
Well, first up this week is Eurostar, operator of the Channel Tunnel trains. They have gone cap in hand to both the British and the French governments for a bailout, as journeys through the tunnel have dropped by 95% during the crisis. Now, it's a bit complicated, but French rail operator SNCF, itself wholly owned by the French taxpayer, they own 55% of the shares in Eurostar. Now, the other shareholders, they include fund managers and the Belgian state rail operator. They've already stumped up 200 million euros to keep the company afloat. SNCF itself has already received billions of euros in support from the French government because of a fall in traffic generally in France. But the UK government has issued no statement on any help, apart from to say that the French should take the lead, as the UK government sold its stake in the company back in 2015. Moving now to China and technology, and Colin Huang, the founder of Pinduoduo, Duo, an e-commerce company, is set to leave the firm. Huang said in a statement that he was looking to explore new long-term opportunities as the company grew from being a youth to an adolescent. Apparently, he led the company to listing on the New York Stock Exchange back in 2018. It's now valued at close to $200 billion, and it's taken a substantial share of China's online shopping marketplace. And finally, that story I mentioned about corporate governance you were touching on, Marcus, Softbank is in the news again this week because it's emerged that another of its investments has failed. So in 2019, Softbank hit the headlines when its investment in office sharing company WeWork basically just ran into trouble. The problem was that the founder of WeWork, Alan Newman, got to cash out huge sums of money. Before then, the wheels fell off, the stock market listing was halted, and the company ended up fighting for survival. Well, it seems history has repeated itself. Grensill Capital is the firm this time, and the Grensill family sold about $200 million of shares during a funding round with SoftBank in 2019, before the company itself then collapsed 2 years later. Now, Greensill Capital was founded as a lender in supply chain finance, and it was lauded as one of the UK's leading fintech firms back in 2011 when it launched. Even David Cameron was asked to be an advisor, but today, sadly, the jobs of several hundred employees are at risk as a deal to sell part of the business failed last week. Okay, well, on to more positive stuff now as we take a look at property investing. And this week, Marcus spoke to Blend Network about how peer-to-peer lending is allowing everyday investors like you and me to get access to this asset class.
Now, last week we heard from fund manager Ben Seeger-Scott talk about the potential for inflation coming out of the pandemic and how real assets could be a good bet in this environment. That's investments in physical assets that have an intrinsic value, such as property, infrastructure, commodities, and the like. Now, property is a classic in this regard and probably an asset that private investors such as you and I are most comfortable and familiar with due to the home owning culture of Brits. But short of owning enough bob to buy yourself another house, how else can you invest in property? To discuss this and the merits of one particular approach, I'd like to welcome onto the pod the Chief Strategy Officer from property peer-to-peer platform Blend Network, Roxana Mohammadian Molina. Roxana, welcome to the pod.
Thank you so much, Marcus. Lovely to be here.
So let's frame property as an asset. Can you give me a little bit of context into maybe the returns, the volatility, and how correlated to mainstream assets like bonds and shares but property might be?
Yes, sure. Property is a very interesting one. Is included in the alternatives asset class, along with commodities, for example. Just to give you, some big numbers in the UK, in particular, at the moment, property prices are at an all-time high. So the average house in the UK will cost you somewhere around £230,000. Over the past 20 years, prices have increased by a staggering 175%. Over the past 10 years, prices have increased by just over 40%. And over even the past 5 years, so after the 2008 and 9 crisis, prices are up by 17%. But it is, very regional. So it is very different whether you look at prices in central London or in the Midlands or in the north of the UK. So it is a very heterogeneous asset class. Is not like essentially it's not a commodity. Real estate. So in that sense, I think in the UK we can talk about a two-speed property market. Is very clear. London versus the rest of the UK. London, central London is driven by factors that are, such as the people working in the city of London, a lot of overseas investors, and overseas investment money being put in the property market. However, in the rest of the UK, the factors driving prices have traditionally been simply supply and demand. And in that context, we know that the UK is one of those countries that traditionally has had a structural shortage of housing. So, first-time buyers, people wanting to get on the property ladder, there is just not enough supply of houses compared to the demand for houses. So, I think in that sense is very interesting. And so talking about the prices of UK property price just as a whole, it is very difficult because it is a very regional and fractional market.
And tell me about where we are currently, because it seems as if in the press what we hear is that Brexit could have been a bit of a shock. I mean, how have prices held up against some of the more near term events that are going on in the market?
Yes, sure. So, around the election in late 2019, we saw, the last election, we saw a mini boom in prices. In 2020, I meant. We saw a mini boom in prices. And after that, obviously came, the COVID-19, and essentially the market was closed for a couple of months. Now, after starting in June, I got confused with the days, the election. So starting in June 2020, we saw a sharp rally in prices, in house prices in the UK. So over the month of the summer, between July and September, we really saw the sharpest increase in prices over the past 10 years. And this was really interesting because it stood against a backdrop of a lot of uncertainty around COVID and the furloughs, and essentially basically the largest economic slowdown in history. So the fact that the property market was performing so well, it took many people by surprise. Obviously, there were many factors, and the stamp duty was one of them. So now in January, we have seen a little bit of a slowdown in prices, but obviously everyone is looking at the news tomorrow and the expectation that the stamp duty will be extended for another, stamp duty holiday will be extended for another 3 months. So at the moment, we are in a place where some pockets of the UK property markets are performing very, very well. And those markets, I think they really have to do with the places where the government has, showed that they want to support the local economy by investing in infrastructure. So places such as the Midlands, places such as, the north of the UK. Boris Johnson's government, they have said that, they want to address that historical north-south divide, and they want to be investing more in the north of the UK. So that really has created a lot of excitement in those areas, and we have seen a big increase in property prices around those areas. Obviously, central London, it has been a very different story. So we have seen a lot, less performance, and also is a different market. So, big houses, expensive houses is a very illiquid market.
Interesting. So let's move on then to some options that you have if you're thinking about the property market. And I think let's ignore, we don't have a lot of time to go through all of them. I think maybe let's ignore the direct approach. How would investors go about investing in property in a more liquid approach?
Yes, so as you say, if you want to invest in property, there are many different options. Obviously, buying a property outright, that's an option. Buy to lets, HMOs, many people do that. But there are obviously, in order to do that, first of all, you need to, have the investment to buy a whole property. Not everyone does. Then obviously buying a house to rent has a lot of maintenance. So you need to maintain the house. If it's, far away from where you live, you need to have someone local to maintain it. So it is not, an easy investment that you can do from your laptop. So one option that we focus at Blend Network is peer-to-peer property lending. So what is peer-to-peer property lending? So peer-to-peer property lending is essentially lending money to property developers who are building houses. So it's a loan. So the product is a debt product. So for example, you may decide, if you go on a platform such as Blend Network, you will see different projects, different property projects. So for example, a recent project that we have is someone who is an experienced property developer, and he wants to convert a former care home into 12 apartments. So we lend money to this property developer. And so every person who comes in on the Blend Network platform, they can lend any amount they want to this project. The minimum amount is £1,000. The return they get is somewhere between 8 and 12%, depending on the project. And the loans are secured against first charge on the property. So this way of investing in property, essentially, it allows investors to get access to the same or similar returns as they would get by buying a physical property. So somewhere around 8 to 12% return. Their investment is a lot more liquid because essentially the maturity of the loans are somewhere around 18 months. However, some platforms, including our platform, they have a secondary market where investors can sell their loan part before the maturity. So let's say you invest £10,000 in a loan, and then you need your money after 3 months time. So you can put your loan in the secondary market, and then someone else will come and buy that loan part. So essentially, it is a much more liquid way to invest in property, and also people can invest from starting from £1,000. So there's no need to put down the whole obviously price of the property. But I think one way or another essentially is not excluding many people that we have investing in our platform. They have all those different options. So they buy physical property. They also do peer-to-peer. So it's not one or the other. Is essentially diversifying your portfolio.
Right, okay, because this idea that you have lots and lots of tiny little investors it's quite a new way of syndicating risk, am I right? It's completely changed the way in which risk is perceived within these sorts of areas of investment.
Yes, exactly. The origin of peer-to-peer goes back to actually the 2008 and 9 financial crisis. So, the main question that people ask when they want to invest is, so why are these property developers not going to the bank to borrow money for their projects? And the answer is very simple, is because the bank is not lending to them. So, before 2008, 2009, if you were a property developer, you would walk to Barclays or HSBC, any high street bank, and they would lend to you for development finance. This is development finance. But nowadays, they don't. Barclays, HSBC, they don't provide development finance, especially if you are a small and medium property developer. If you are looking to borrow somewhere, 3 to 5 million, so that's an SME developer. So then what do they do, these property developers? Well, they don't really have any other options, and that's where peer-to-peer came in. So peer-to-peer provides them development finance, and essentially, so peer-to-peer is solving a double problem. So on one side is providing development finance to property developers who otherwise would not have access to funding, and on the other side is also helping investor access yield, because if you are an investor and you have money at the bank, you would know that the interest rate on bank deposits is close to zero. It's been close to zero for a decade. So peer-to-peer is connecting those lenders and those borrowers, as you said, in a syndicated loan platform, and everything is automated through the platform.
That's interesting. So one single bank wouldn't have wanted to take on the risk from a smaller property developer, but when you fragment it and send it out over a bunch of lots and lots of little investors, then that completely changes that risk profile and makes it more doable. And then on the other side, you had investors who have just experienced low rates for so long, they're now starting to go into these more unusual areas of finance in order to try and get a yield.
Yes, exactly. And we are increasingly seeing not only retail investors, but institutional investors also being interested in the space. Family offices, high net worth individuals, because a lot of family offices and high net worth individuals, they already invest in property. They do direct lending to property developers, but a peer-to-peer platform is used as an origination vehicle, because many high net worth or even retail investors, you could be going and lending to someone who wants to do a project, but obviously it is not easy to find those developers who need the funding to do the due diligence, which is very, very important on the loans. So so peer-to-peer platforms are used as a way to access those investment opportunities.
What can you do this in a tax efficient way? Are you allowed to invest in these in your ISA?
Yes, yes. So some platforms offer ISA, and also you can invest in as an individual, or you can invest as a company. So, for example, if I have a company, I can register as a company lender and lend through my company. In which case, you obviously pay, the corporate tax. So there are many different ways to invest, and also people can invest their SIP and SAS. We actually have a lot of people investing their SIP and SAS through the platform. So there are many different ways to invest.
What about, some of the risks? I mean, how do you ensure that you haven't got dodgy property developers coming to your platform?
Yes, so this is the key part. This is the most important part. And when I have heard in the past some platforms, essentially calling themselves like a matchmaker for lenders and borrowers, which I think is the completely wrong approach, because the key for any peer-to-peer platform is the due diligence done on the loans, and that is the only way that you can build a strong track record. So due diligence, I can tell you how we do the due diligence. For us, is the biggest, most important part of the lending. The lending team is the biggest part is the biggest team in our company. So we take a very, old-fashioned, may I say, approach. So in terms of like going to actually visit the site, we visit the site, we meet with the property developer, we try to really understand their experience. So we learn to experienced property developers who have done similar projects in the past. I think in property, one thing that everyone will tell you is in property development, some things will always go wrong. Things will always get delayed. But if the team is experienced, then they can find solutions. And this is the most important thing. Last year, obviously, was a very difficult year, and many, property developers that we had lent to, they had a very challenging time. But we have zero loss. Why? Is because even in challenging times, if the team has the expertise, they will find a solution. So part of the due diligence is really going through the experience of the team that you are lending to check that they have done similar projects in the past. The security of the asset, we take first charge on the property, on the security. So if something goes wrong and they cannot repay the loan, then we can and we will step in to liquidate the property and to recover the money. So it is really the due diligence is really for us is a old-fashioned way, in the sense that it's not automated, or you put it in a spreadsheet and it tells you whether you should lend or not. We really believe in the power of looking the borrower in the eyes and trying to understand whether they have the experience and what it takes to develop the project.
And I mean, so what are the risks of the downside? Because we have to be honest about those. You don't get between 8 and 12% for nothing. So what risks do exist within investing in this way?
Yes, absolutely. There are risks, as you say, it's 8 to 12% return. The risk is that the borrower doesn't repay the loan. So the product is a loan. You are lending money to someone, and the risk is that the borrower doesn't repay you back. So how do we mitigate the risk? So we mitigate the risk, first of all, and most importantly, by taking a first legal charge on the property. Which is the same thing as any bank would do when you take a mortgage. The bank takes a first legal charge on your property. So if the borrower doesn't repay, then we as the lender, we step in and we liquidate the asset and we recover the money. So that's the most important thing. The second thing is the loan to value ratio. So obviously, in when it comes to mortgages, people are used to hearing 90-95%. It's not the same in development finance. Our average loan to value is less than 60%. So that means that we are lending less than 60% of the value of the property. So if someone wants to build a house that's worth 1 million, we would not lend more than 600,000 pounds. And that obviously that ensures that if something goes wrong and we have to step in to liquidate the property, then we have enough room, space to be able to recover the investors' money. So loan to value is very important. And then another factor that we do as well to mitigate the risk is to lend in markets that we think are very strong. And I tell you one example. For example, as I said before, the central London market is a market that is not very liquid. So if you're lending to someone who wants to build a 5 million house in Mayfair, then the risk of that is that when it comes to selling the house and to repaying the lender, the person cannot sell the house, because you can't sell a 5 million house every day. It takes time and there are not many buyers. But we focus on funding more affordable low cost housing. So we would typically fund £100,000 to £200,000 flats, or £200,000 to £300,000 houses in the regions, because that is a very liquid market, because there's a lot of first time buyers. And obviously now with the government announcing 95%, potentially announcing 95% mortgages, that is a very strong market. There's a lot of first time buyers buying those type of properties, so it is a lot more liquid for us. The exit is a lot more liquid for us.
Okay, I just wanted to focus a little bit on the technology behind this, because I think this is quite interesting. I mean, you might call this prop tech. I mean, but it's really around peer-to-peer kind of lending. Why is this a new thing? I mean, how is it that peer-to-peer lending is suddenly being made available to people?
Yes, it's all about really the technology and how easy it is to access those loans and to invest, mainly for the lenders through the platform. As I said, the borrower is actually quite a manual journey, because we think that that's the way to maintain the quality of the loans. But the lender journey is fully automated. So you register, you sign up, you put a copy of your ID, so we can do the KYC at the AML. And then essentially 24 hours later, you are completely onboarded, and you can, through a platform, from a phone, from your iPad, from your laptop, pick and choose what loans you want to invest in, pick and choose how much you want to invest in, and essentially do everything from a click of your laptop. So I think it's that automation that really is adding the value here, because lending itself is nothing new. You can actually you can go and lend money to a property developer the old way. But obviously, first of all, where do you find that property developer? How do you do your due diligence? So I think the value added here is the technology, how easy it is to essentially invest from beginning to end. You invest, and when the loan is then when the loan is repaid, the money automatically comes back into your e-wallet, and then you just put it in your account. So it's simple, it's easy.
Okay, interesting. Final question here then is just around crypto assets. I mean, I remember reading a little while ago that crypto assets could be one of these technologies that revolutionizes the way in which property changes hands, because there's so much due diligence and paperwork effectively that's done when properties are changing hand. This idea that smart contracts could bake in a lot of that legal work into specially designed crypto assets, and therefore enable us to transact property a lot more quickly. Is this something that you're seeing? Do you think this is a technology that will emerge in the property market?
I think we are already seeing this in the peer-to-peer business lending and peer-to-peer consumer lending, but we are seeing it a lot less in the property space. And I think the reason for this is that you don't have the same amount of data in the property space than you have it in business or in consumer lending. Because, for example, consumer lending, so you have a lot of data on the person's history, credit history, everything. You have the credit history has a lot of data. But for us, on the property side, when we lend to someone, we lend to an SPV. So the borrower essentially creates we don't lend to the borrower as a person, we lend to the borrower as a company. So the borrower creates an SPV, a limited company registered in the UK, and then we are lending to that limited company. So when you do that, it means that the company has just been created. And for every project, they will create a different company that's called an SPV. So there is not a lot of data on that because they just create the company for that project. And when the project is funded and the loan is repaid, they close the company. So we basically, there is not the same amount of data in the property peer-to-peer lending as there is in the business lending or consumer lending. And that is the reason that we have not so far used the crypto and all these technologies.
Roxana, Mohammadi and Melina, thank you very much for joining me.
Thank you, Marcos.
Well, that was, as ever, a fascinating interview. I mean, there's lots of stuff in there I didn't know, if I'm going to be totally honest. Peer-to-peer is not something I've looked at in a great amount of detail. But one thing that did strike me at the end when you were talking about risk was just how much they do to mitigate risk, because I like you saw the sort of 8 to 12% number over 18 months and thought, well, this is almost too good to be true. And the fact that the peer-to-peer lending firm owns the property, they're only giving loan to value of less than 60%, so should always be some value in the property left to extract if the worst were to happen, and the fact that they're not funding, as you said, £5 million Mayfair mansions. These are £200,000 houses where the market for that kind of property has many more buyers and therefore is what we call much more liquid. The fact that all of that is happening and they're doing this kind of due diligence on the property developers in the first place before they can even get a loan, I think is a really they're doing, I think, probably as much as they can do to mitigate those risks.
Yeah, I think you're absolutely right there. That was quite encouraging to hear. Of course, I'm going to balance that a little bit. And I would say part of that reason why we're getting that 8 to 12 quite juicy return is this illiquidity risk. And, so they talk about the fact that, well, if you want to get out of your loan, you can go to our secondary market and sell it on. I also read in the small print that they warn that can take quite a bit of time and you may not find a buyer for that loan. So I think that's a key part of why you get that return, is because it might be quite difficult to get out of something like this. So I'll tell you what, it's a good thing to consider. I think peer-to-peer is an interesting part of a more satellite part of your portfolio. But what we will do in a future episode is have a look at some quite liquid options, mainly in the form of real estate investment trusts. So we're going to do that in a future episode. REITs are pretty important. So I think that'll be an interesting one for you as well.
Well, and of course, there are also investment trusts that invest in peer-to-peer lending firms. They also exist, so you can get one step back from the risk as well. Okay, what's on the show next week, Marcus?
Yeah, so next week we have, it's quite an interesting topic. It was one that was requested by one of our listeners, and that's venture capital trusts. So these are quite specific investment trusts, and the focus of them is much earlier stage financing for businesses that are not public yet. They're still in the private sphere. So they're a much more risky, much earlier stage part of business financing. And to answer some of those questions, we've got a bit of a VCT expert from the industry body for investment trusts, the Association of Investment Companies, and that guy's name is Nick Britton. So very much looking forward to interviewing him.
Okay, join us again next week for that. Until then, thank you to Roxana. Thank you for listening. Until then, it's goodbye from us. Goodbye.
Goodbye.